Imagine you are building an extension on your house, and you buy a measuring tape from the local hardware store. You measure out the wooden beams, cut them perfectly to size, and nail them together, but nothing fits. The walls are crooked, the roof caves in, and the whole structure is a total disaster. You finally realize the problem isn't your carpentry skills, it is the measuring tape itself. The inches on the tape are actually shrinking every single day while you work. That sounds completely absurd, but it is exactly what is happening to the money sitting in your bank account right now. We blindly trust the currency we earn to measure our wealth, completely ignoring the fact that the unit of measurement is secretly collapsing. You see, we have been conditioned to look at a £5 note or a $10 bill and think of it as a fixed, unchangeable store of energy. You worked a certain number of hours, traded your sweat and stress for that piece of paper, and you expect it to hold that exact same energy until you are ready to spend it. But that paper is not money, it is a currency, and those are two drastically different things. True money has to hold its purchasing power over long stretches of time, acting like a pristine, sealed vault for your labor. Currency, on the other hand, is designed to be a leaky bucket, constantly dripping your purchasing power away so you are forced to keep working, keep spending, and keep paying taxes. The financial system we operate in today is essentially a massive game of Monopoly, where the bank is allowed to secretly print its own money under the table whenever it feels like it. If you and I are playing Monopoly and I keep slipping myself extra $500 bills from a hidden stash, the hotels on Boardwalk are going to get incredibly expensive very quickly. It is not that the cardboard hotels are suddenly worth more. It is just that my flood of fake cash has completely diluted the value of the bills you are holding. That is precisely what central banks have been doing for decades, flooding the system with new currency units and silently draining the purchasing power right out of your hard-earned savings. The mechanics of how this new currency enters the system is the real kicker, because every single dollar or pound is born out of debt. When a government wants to spend more than it collects in taxes, it issues a bond, which is just a fancy IOU, and the central bank creates brand new currency out of thin air to buy it. But here is the fatal flaw in the system. They create the currency for the principal loan, but they never create the currency to pay the interest. This creates a terrifying treadmill effect where the economy has to constantly run faster, taking on more and more debt, just to generate enough currency to pay the interest on the old debt. If the treadmill ever stops, the entire system collapses. Because the system requires a never-ending flood of new debt and printed currency to survive, that excess cash has to find a home somewhere. It cannot just sit in bank accounts losing value to inflation, so it gets shoved blindly into the stock market and real estate. We are currently living through what is arguably the largest financial bubble in human history, where stock market valuations have completely detached from the underlying economic reality. The Buffett indicator, which compares the total value of the stock market to the size of the entire economy, is screaming that equities are historically overpriced. It is like an umbrella salesman hiking his prices by 300% during a brutal drought. The price has utterly lost its connection to the actual environment. When people finally wake up and realize they are trapped on an airplane with a failing engine and a pilot who just keeps hitting the throttle, they start looking frantically for a parachute. Historically, that parachute has always been physical gold and silver. For thousands of years, these metals have been the ultimate fail-safe, the only financial assets that do not rely on a politician's promise or a central banker's printing press. They are the financial bedrock that survives every currency collapse, every hyperinflation event, and every sovereign debt default. But while gold is the heavy, stable anchor that central banks themselves hoard, silver is the wildly coiled spring sitting quietly in the corner, ready to absolutely tear the roof off the building. Silver is completely unique because it lives a bizarre double life. On one hand, it is a precious metal with a 5,000-year pedigree as real, honest money, used by average citizens to buy groceries, pay debts, and save for the future. On the other hand, it is the most vital, irreplaceable industrial metal on the planet, completely essential to the modern technological age. It is the best conductor of electricity, the best conductor of heat, and the most reflective element known to humanity. You simply cannot build a smartphone, a solar panel, an electric vehicle, or a guided missile without consuming physical silver. It is a monetary safe haven that is simultaneously being devoured by the tech industry at a breakneck pace. To understand just how distorted the silver market is right now, you have to look at the gold-to-silver ratio, which is essentially the price tag of gold expressed in ounces of silver. For the vast majority of human history, from the Roman Empire right through to the early 20th century, this ratio was remarkably stable at around 15:1. This made perfect geological sense, because silver comes out of the earth at roughly a ratio of 8 or 9 parts to every 1 part of gold. If you were a miner pulling metal out of the dirt, you would naturally find about 8 ounces of silver for every ounce of gold. But today, the financial markets have completely ignored nature and skewed this ratio to absolutely absurd extremes. Right now, the financial system prices gold at roughly 80 to 90 times the value of silver, completely ignoring the geological reality of how much metal is actually available. This distorted ratio is like a massive industrial rubber band that has been stretched so far past its natural resting point that the tension is practically screaming. Every time in modern history that this rubber band has been stretched to these extreme levels, it has inevitably violently snapped back, sending the price of silver launching upward like a rocket to close the gap with gold. The tension on that rubber band today is greater than almost any other point in history, and the underlying fundamentals are setting the stage for a snapback that will catch the entire market off guard. The fundamental reality driving this impending snapback is a massive structural supply and demand deficit that nobody in the mainstream financial press seems to be talking about. We are currently consuming vastly more physical silver globally than we are pulling out of the ground, and we have been running this massive deficit for years. The green energy transition is acting like an enormous industrial vacuum cleaner, sucking up millions of ounces of silver for solar panels and electric vehicle batteries. This is not a temporary blip, it is a permanent, accelerating trend. The industrial demand for silver is a giant pressure cooker with a blocked release valve, and the heat is being turned up higher every single day by government mandates for green energy. Here is the truly mind-bending part about silver that separates it completely from gold. When humanity mines an ounce of gold, we melt it into a beautiful bar or a coin, lock it inside a heavy steel vault, and sit on it for centuries. Almost all the gold ever mined in human history is still sitting around today in some recognizable form. Silver, however, is an industrial workhorse that gets consumed in microscopic amounts inside televisions, keyboards, medical devices, and car electronics. It is incredibly expensive and highly toxic to recycle these tiny slivers of metal, so we do not bother. Millions of ounces of precious, unrecoverable silver are literally thrown into massive trash landfills every single year, permanently removed from the global supply chain forever. Because we treat silver like a disposable industrial garbage commodity rather than a precious monetary asset, we have arrived at a truly shocking mathematical reality. Today, there is actually less highly refined, investable, above-ground silver available to buy than there is gold. Let that sink in for a second. We have a metal that comes out of the ground 8 times more frequently than gold, yet because we aggressively consume it and throw it away, the actual stockpile of refined silver bars and coins sitting in vaults is smaller than the gold stockpile. It is an absolute paradox. Silver is structurally rarer above ground than gold, yet the financial markets are pricing it as if it is 80 times more abundant. It makes absolutely no sense. The reason this glaring discrepancy exists is because the price of silver is not determined by the exchange of physical metal, but by paper contracts on commodity exchanges. Financial institutions trade billions of ounces of digital silver every single day, creating massive paper claims that have almost no backing in the real world. It is the ultimate game of musical chairs, where hundreds of paper claims float around for every 1 actual physical ounce of silver sitting in the vault. The people trading these contracts rarely want the physical metal, they just want to pocket the currency difference, creating an artificial illusion of infinite supply. This paper derivative market acts like an enormous, heavy wet blanket thrown over the true price of physical silver, suppressing its value and hiding the severity of the supply shortage. When industrial manufacturers need silver to build solar panels, they do not want paper contracts. They need the heavy, shiny physical metal delivered to their loading docks. But because the paper price is so artificially low, mining companies cannot afford to invest billions of dollars into exploring and developing new silver mines. The paper market is essentially starving the physical supply chain of the capital. It desperately needs to keep functioning. We are burning through our above-ground stockpiles to subsidize a fake paper price, and those stockpiles are draining rapidly. You can actually see this physical drain happening in real time if you look at the registered inventories of the major commodity exchanges, like the COMEX in New York or the LBMA in London. Over the last few years, the amount of physical silver sitting in these vaults ready to deliver against those paper contracts has been quietly bleeding out. Industrial users and smart investors are showing up, handing over cash, and backing their trucks up to the loading bays to take the physical metal home. It is exactly like a slow-motion bank run, but instead of panicking depositors demanding their cash, it is massive technology corporations quietly draining the vaults of a vital raw material before the rest of the market catches on. If the physical vaults keep draining at this pace, we are going to hit a wall that paper traders simply cannot fake their way around. You cannot build a cruise missile or an electric vehicle out of a digital futures contract. When an industrial manufacturer calls the exchange and demands physical delivery, and the exchange has to admit the vault is empty, the illusion shatters instantly. The moment the market realizes the musical chairs game is over and there is no physical metal left to back the paper claims, the paper price will become completely irrelevant. Buyers will be forced into the real world, wildly bidding up the price of whatever physical silver they can find just to keep their factories running. When you finally combine this terrifying physical supply shortage with the snapping of the historical gold-to-silver rubber band, the math pointing to triple-digit silver becomes blindingly obvious. If gold simply stays at its current valuation of around $2,500 an ounce, and the silver ratio reverts to its conservative historical norm of roughly 15-to-1, silver fundamentally has to price itself well over $160 an ounce. That is not wild speculation or wishful thinking. That is just a basic reversion to the mean. It is simply history correcting a temporary pricing error that has been artificially sustained by paper derivatives and a complete misunderstanding of silver's modern industrial scarcity. But that conservative calculation assumes the central banks suddenly stop the printing presses and stabilize the fiat currency system, which we know is mathematically impossible. The debt treadmill is running hotter than ever, and governments are running multi-trillion-dollar deficits during periods of supposed economic expansion. When the next major financial crisis hits, the only tool they have left in the toolbox is to flood the system with another tidal wave of freshly printed currency. As the purchasing power of the dollar and the pound continues to rapidly melt away, the nominal price of gold will shoot exponentially higher. If gold goes to $5,000 or $10,000 an ounce, a reverting ratio will drag silver straight through the triple digits with terrifying speed. Silver has historically been the primary financial lifeboat for the working class because it is accessible in a way that gold simply is not. If you are an average bloke working a regular job, dropping a couple of grand on a single ounce of gold is a massive, highly intimidating commitment. Silver, on the other hand, allows you to protect your purchasing power in small, manageable increments. It is the loose change of the precious metals world, allowing you to gradually exchange the shrinking fiat currency in your wallet for heavy, tangible, industrial wealth. It is the working man's shield against central bank inflation, quietly preserving the energy of your labor while the financial elites play reckless games with the global economy. The biggest psychological barrier preventing people from seeing triple-digit silver is the metal's historical inability to decisively break through the $50 mark. Silver hit $50 an ounce back in 1980 when the Hunt brothers famously squeezed the market, and it hit $50 again in 2011 during the fallout of the global financial crisis. People look at those charts and assume $50 is an impenetrable ceiling, a solid brick wall that silver simply cannot smash through. But they are completely forgetting to factor in 40 years of relentless currency debasement. $50 in 1980 possessed massively more purchasing power than $50 today. In inflation-adjusted terms, the real all-time high of silver is well over $150. When silver finally summons the momentum to aggressively smash through that nominal $50 ceiling, the psychological shift in the market will be absolutely violent. It will trigger a massive technical breakout that pulls in massive algorithmic trading funds, momentum chasers, and average retail investors who suddenly realize what they have been missing. It will be like watching a massive dam finally give way after decades of mounting water pressure. The price discovery will not be a slow, polite climb. It will be a vicious, vertical revaluation as decades of suppressed paper pricing are instantly corrected by the brutal reality of physical supply and demand. Those who hold the physical metal before the dam breaks will be sitting on generational wealth protection. It is crucial to understand that holding physical silver is not about executing a flashy get-rich-quick scheme or timing the market perfectly to buy a luxury sports car. It is fundamentally an insurance policy against the reckless mismanagement of the global fiat monetary system. When you buy a silver coin, you are stepping entirely outside the traditional financial matrix. That coin has no counterparty risk, it cannot be hacked, it cannot be deleted by a bank computer glitch, and its value cannot be voted away by a desperate politician looking to fund a new spending program. It is quiet, heavy, unapologetic financial sovereignty resting right there in the palm of your hand, completely immune to the chaos of the digital world. You also have to look at the absolute state of the silver mining industry to understand why a massive supply response is simply not coming to save the market. Mining is an incredibly brutal, capital-intensive business, and right now, the cost of diesel fuel, heavy machinery, and human labor is skyrocketing due to inflation. Because the paper price of silver has been kept artificially low, the profit margins for miners have been squeezed to the point of suffocation. They simply do not have the spare cash to spend a decade navigating environmental permits and drilling holes in the side of a mountain to find new silver veins. The pipeline for future silver supply is virtually empty, and you cannot magically conjure a working mine overnight. Furthermore, about 70% of the silver pulled out of the earth is actually just a lucky byproduct of mining for other metals like copper, zinc, or lead. These massive base metal mines only produce silver as an afterthought, while they are digging for materials to build pipes and wiring. If the global economy slows down and the demand for base metals drops, those mines will scale back operations or shut down completely, inadvertently choking off the global silver supply even further. Silver supply is heavily dependent on the health of the broader industrial mining complex, making it incredibly fragile and utterly incapable of rapidly scaling up to meet the exploding demand from the green energy sector. Let us take a closer look at the solar energy sector alone, because the numbers are absolutely staggering and practically guarantee a violent supply squeeze. The latest generation of highly efficient solar panels requires significantly more silver paste than the older models, and governments around the world are aggressively subsidizing the installation of massive solar farms to hit their net zero climate targets. The solar industry is already consuming hundreds of millions of ounces of silver every year, and that trajectory is climbing on a vertical hockey stick curve. You have unstoppable political mandates colliding head-on with an inflexible, shrinking physical supply of a vital raw material. It is a slow-motion train wreck for manufacturers, but an incredibly bullish scenario for silver prices. The electric vehicle revolution is throwing another massive bucket of fuel onto this raging demand fire. A standard internal combustion engine car uses a small amount of silver for its electrical contacts, but a modern electric vehicle is essentially a massive rolling computer that requires significantly more of the metal. From the battery management systems to the autonomous driving sensors to the charging infrastructure built into the streets, the electrification of our transport grid is completely dependent on silver's unmatched conductivity. As the major automotive manufacturers aggressively phase out petrol cars over the next decade, They are going to find themselves locked in a desperate, bare-knuckle brawl with the solar industry over a rapidly dwindling pile of physical silver. Despite all these glaring, flashing warning signs, the massive institutional money managers on Wall Street and in the City of London are almost entirely ignoring silver. Trillions of dollars of pension funds and wealth management portfolios have zero allocation to precious metals, completely obsessed with chasing the latest tech stock rally or hiding in government bonds that yield less than the rate of inflation. They are driving blindly towards a cliff, completely trusting the central banks to keep the debt treadmill running smoothly forever. When the realization finally hits that inflation is structurally entrenched and the fiat system is broken, even a tiny fraction of that institutional capital desperately trying to squeeze into the tiny physical silver market will send the price into the stratosphere. What we are really talking about here is preparing yourself for the greatest wealth transfer in human history, from those who blindly trust paper promises to those who hold tangible hard assets. Every fiat currency ever created by humanity has eventually returned to its intrinsic value of zero, collapsing under the weight of debt and rampant money printing. It is an unbroken track record of failure spanning thousands of years. The dollar, the pound, and the euro are not magical exceptions to this historical rule. They are just currently experiencing the final, chaotic stages of their inevitable decline. Protecting your labor by converting dying currency into a historically proven, industrially vital metal is simply a matter of basic financial self-defense. The reality check here is that you do not need to be a Wall Street insider or an economic professor to see the writing on the wall. Just look around at your everyday life. Your groceries cost more, your utility bills are through the roof, and the dream of buying a home feels increasingly out of reach for average people. The measuring tape of our money is broken, and the people in charge are actively trying to hide the damage by manipulating the numbers and printing more fake currency. You can either stay on the treadmill, running yourself to exhaustion while the value of your savings evaporates, or you can step off, buy a hard asset that cannot be printed, and secure your own financial future. Going back to triple digits for silver is not a matter of if, but simply a matter of when the underlying mathematical reality finally shatters the paper market illusion. The rubber band of the gold-to-silver ratio is stretched to a tearing point, the industrial pressure cooker is boiling over with unprecedented demand, and the fiat currency system is slowly bleeding out. When you hold a physical silver coin, you are holding a piece of finite reality in a world utterly obsessed with digital illusions. It is time to stop measuring your wealth with a shrinking yardstick and start anchoring it to the heavy, shiny truth that has survived every financial crisis in human history. The vault is draining, the music is stopping, and the true value of silver is about to be violently revealed.